When you choose between an ACH transfer and a wire transfer, your bank is not just processing a payment differently, it is applying a completely different monitoring framework to the transaction. Most business owners think of ACH and wire transfers as interchangeable ways to move money with different speeds and costs. From a compliance perspective, they are fundamentally different transaction types. They sit in different regulatory frameworks, carry different risk profiles within the monitoring system, and trigger different review thresholds. ACH transfers move through a batch processing network and are subject to behavioral monitoring that compares each transaction against your account's established pattern. The monitoring system is looking for deviations. An ACH that is larger than usual, sent to a new recipient, or inconsistent with the transaction timing you have established over time. Because ACH transactions can be returned or reversed after they process, the bank's primary concern is pattern deviation rather than immediate irrevocable loss. Wire transfers operate under a separate framework entirely. They are irrevocable. They move immediately. And as a result, they carry a higher inherent risk signal within every bank's monitoring system. A wire transfer to a new recipient, an international destination, or for an amount outside your established range, will typically receive a higher level of automatic scrutiny than an equivalent ACH transaction, regardless of how legitimate the purpose may be. For businesses that regularly use both, the monitoring system is effectively building separate pattern baselines for each transaction type. Understanding those two baselines, and how each one gets tested, helps a business owner make intentional decisions about which payment method creates less friction for a specific transaction. It also explains why using a wire transfer for something a routine ACH could handle may place that transaction under a more intensive level of scrutiny than necessary.